Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Victor Adair, co-founder of the Polar Futures Group. He's Senior Vice President and Derivatives Portfolio Manager at PI Financial in Vancouver. His website, polarfuturesgroup.com. Welcome back to the show, Victor.
Thank you, Jim. Good to be back with you.
American stock indices hit 3.5-year lows in March. They've rebounded very strongly since then. The Dow Jones is up about 7,500 points, or 40% in the last 2.5 months. The huge rally in the stock market has happened despite lockdowns, unemployment, U.S.-China tensions rising. Now the market continues to go higher despite mass protests and looting across the U.S. What's the deal behind the stock market?
Yeah, I have this conversation with my son Drew, who works with me, and I guess maybe my best shorthand answer is it doesn't have to make sense. I think really, doing an assessment of what we call the macro environment and doing an assessment of where the market is. He's not buying them so he can sell them next week for a flip. He talks about he's going to buy them and own them forever because it's a good business, and he's looked at their balance sheet and he sees that they're making profits and their prospects are good, and and on that sort of thing. So with the economy just getting clobbered the way it has, and the fear that's been out there in terms of, I call it demand destruction. It's been massive, and I just personally, I just don't think it's going to come roaring back. Call it a V-shaped turn in the economy. So I have thought that as this rally off the lows in the stock market got going, that it was a classic bear market rally. So let me back up a little bit. If we go back to October of last year, 2019, from the lows of that month to the highs in the stock market that were made in February, the S&P, for instance, the major benchmark, was up over 20%. And when we were at the highs in February, to my mind, the market at that point in time was just like priced for perfection. Then the virus, I should say, came along and kind of acted as a catalyst, and the market started to fall. It was like, as my mom might have said years ago, the market was cruising for a bruising at that point. So we had the tumble begin, but then I think there was something different this time around. It wasn't just like a financial screw up, as we may have had in other bear markets. This time there was this existential fear from the virus, a health issue. It was unfathomable. So the market really picked up momentum to the downside. The volatility, as we measure it in different ways in the market, and not just in the stock market, but in currencies and other markets as well, just went to astonishingly high levels. And we got down to, call it the third week of March there, around the 20th of March, 23rd of March, and we made this bottom. So at that point, I think the markets were severely oversold. The bearish sentiment was extreme. I mean, the S&P had dropped 35% in a month, basically. So then, that sets the stage for the Federal Reserve, and in their part, other central banks around the world, come in huge size. I mean, even using the expressions to the effect of, they will do whatever it takes. And I remember in one of my blogs back then, I said, do you think they're kidding? Do you think that they don't mean this? We also had, of course, the government come in and issuing checks to people. So the market started to rally after having had this crash. Really, that's all you could call it. I think the rally since the March lows, and this I'm coming back to present time here now, has run further than I expected. As I say, I thought it was a bear market rally that, we'd had a 10-year bull market from the lows of March of 2009 to the highs of February of this year. 10 years of a huge rally in stocks. So we've had I thought the first leg down, and it's not unusual to have this a strong bounce. But so far, it seems as though this bear market rally, as I've been calling it, it just keeps going. Makes you wonder in a way who's buying. I mean, we have the numbers that the amount of money that the public has in stock mutual funds, they've been taking money out, so there's net cash outflows there. It seems from surveys that we do of the institutional market that they are not buyers, or certainly not big buyers. There has been certainly some foreign buying, notably the sovereign wealth fund from Saudi Arabia, but others. We've certainly seen that online retail accounts have been buying with both fists, and I think this is kind of, those folks are sort of disparaged. We've seen literally millions of new online retail accounts opened since October of last year, and certainly the volume of trading went up, during the time that people were locked down. You're at home, you got nothing to do, you do your online trading. I even saw that in the UK, hundreds of thousands of people who regularly bet on sporting events had no sporting events to bet on because they're all closed. So these folks switched over to, let's go trade stocks. As my son said, it was like a video game, to some people. We heard from luminaries in the financial markets, Stanley Druckenmiller, Warren Buffett, saying, in effect, they're not buying. But prices have been going up. In some cases, I think you'd have to say there's the Tina effect. In other words, there is no alternative. When you can get virtually nothing for putting your money in, GICs, fixed income, what have you, you look around and say, what can we do? The stock market's going up. Well, let's buy some stocks. There is FOMO, the fear of missing out. Stock market's going up. Geez, I better get in there before prices go up some more. So we've had, in essence, a growing risk-on attitude in the market. And the more the market goes up, that's stronger that risk-on psychology is. And it doesn't just show up in stocks. It shows up across the markets in currencies. Here's a dandy, just to wrap this up. The Brazilian stock market had just got absolutely clobbered. They've got, it seems, the virus is out of control down there. The economy was in a tailspin. Their currency was the poster child for one of the really weakest developing market currencies in the world. And yet, in the last 2 weeks, their stock market has rebounded nearly 50%. So, what do I make of it? Jimmy, it's been quite a rally. I've been wrong in terms of thinking, looking for opportunities to short it the past couple of weeks. And so I've taken my medicine on that, and I'm just a bit astonished. But as a trader, I'll just say, well, I'll wait for an opportunity that suits me, and then I'll get involved.
You mentioned the risk-on market psychology is showing up not only in the stock market, but also in the currency markets. What does that mean in terms of specific currencies?
Okay, fair question. There are individual currencies for different countries, and we trade what we call pairs, like two things, a pair, like a pair of pants. The U.S. dollar is usually the opposite side of most of the trades, or the other leg of the pair that we look at. Like in Canada, we're always thinking in terms of Canada versus the U.S. dollar. But we also, in my world, will trade Canada against yen, Canada against euro, that sort of thing. We have a basket. The U.S. dollar index is commonly used as kind of a basket for how the dollar is doing. That basket is heavily weighted toward European currencies, with a little bit of Canadian dollar, a little bit of Japanese in there. But where I'm going with this is that U.S. dollar index was weakening from the very highs of the stock market this year. As the stocks fell, the U.S. dollar fell until we got to, let's say, about a week into March. And then this fear really started to grip the stock market. In other words, the prices started to drop faster and faster. The existential aspect of, gee, what's this virus going to do? I mean, is anybody safe from it? So while that fear was really showing up in the stock market, it also showed up in currencies. The U.S. dollar soared. I mean, it was up huge. It went to 14-year highs, I believe, when the stocks hit the bottom around the 23rd of March. The U.S. dollar was about at a 14-year high. Since then, the U.S. dollar fell back as fear kind of dissipated. Been choppy for the past couple of months. And wouldn't you know it, the last couple of weeks, the period of time here when, as I just mentioned, the Brazilian stock market is one of the hottest stock markets in the world, up nearly 50%. In that risk-on environment, the U.S. dollar has been weaker. When I look at across the board at different currencies that I trade, one of the biggest winners since the lows in 23rd of March has been the Australian dollar. Aussie's gone up from about, this is Aussie against the U.S. dollar, gone up from about 55 cents to 70 cents. That's nearly a 30% move in just over 2 months. I mean, that is a massive move in the currency markets. And just staying with this risk-on or risk-off story, lately we've seen the Japanese yen and the Swiss franc, which are sort of havens when the world is worried about things. Capital goes into those currencies. Well, in a risk-off world, capital comes out, so the yen and Swissy have been weaker. A lot of the folks that are listening here might not pay attention to this, but there has been a huge move with the euro rising against the Japanese yen. There's like 3 big currencies in the world: the U.S. dollar, the euro, and the Japanese yen, and then a lot of other things are, orders of magnitude lower than that. So to see the euro really soar against the Japanese yen tells you, there's just a big attitude shift in the market. Another popular thing that I follow is the spread between the euro currency and franc. Again, for the past few years, the euro has been getting weaker and weaker and weaker against the Swiss. If you're European and you've got some money, you're worried about everything is going to hell in a handbasket, maybe you push some of your money into Switzerland, the traditional safe haven. Well, the last couple of weeks again, the Swiss has been falling against the euro. And just to finish off, because we're in Canada here, Canada hit a low of, I'm going to say it was 69 cents late in March. We're now up well over 5 cents from that level. The Canadian dollar has, as I so often say when we're doing these interviews, is sort of doing what is the other side of whatever the U.S. dollar is. So if the U.S. dollar is weak, as I've just mentioned, against most currencies, then Canada's probably rallying against the U.S. dollar as well. And certainly Canada has been, I think, when I say Canada, I mean the currency, has been highly correlated to the major stock indices and to some degree also to crude oil, as you'd expect.
We'll have more with Victor Adair right after the break.
Cypress Development Corp is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Media recognition from Bloomberg, Reuters, Recycling Trade Publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with Victor Adair. Victor, gold rallied about $300 from its March lows to hit an 8-year high in early April. Since then, the price has kind of been chopping back and forth on about $100 range. Gold bulls seem to think that all this money printing by the government is very bullish for gold. What do you think?
I'd say yes, but maybe not right away. I mean, the fact that gold did jump $300, and by the way, let's just put that in perspective, in that when I talk about that fear period, when the market just kind of got that existential fear and the stocks were really starting to fall sharply in let's call it leading up to the bottom on March the 23rd, the U.S. dollar was strengthening during that time, and gold fell about $200. So gold did rally $300 once the Fed came in and said, we're going to do whatever it takes, print more money than you can possibly imagine, and so on. But a good part of that was it was just recovering the $200 it had just lost, the previous 2 weeks, and then added another $100 on top of that. And since then, by the way, as you say, it's just kind of chopped back and forth here in about $100 range. So when I'm trading, I always have to ask myself, okay, I got a brainwave, but how much of that is already priced in the market? So let's say the brainwave here is, hey, if the Fed's going to be printing unbelievable amounts of money, that is very bullish for gold. Yes, it is. And gold is up $300, and now you have that brainwave? What, are you going to buy it now that it's up 300? You should have bought it 2 weeks ago. Yeah, right. Shoulda, coulda, woulda. I think more likely in the near term, when these days, what does that mean? The next couple of months, whatever. Deflation is more likely what we're going to see. Certainly in terms of, call it CPI. We're obviously having asset inflation in terms of the stock prices and that sort of thing. But in terms of the real world out there, it looks like maybe there's, been an inventory buildup, lack of demand, all that sort of thing, probably put pressure on prices. You kind of got to think that wages aren't going to be going up in the next little while. There's been so many people lose jobs. We're going to get another major job report coming up this Friday. We'll have a look at that. But, this is a hell of a wide bracket, but something between 20 and 40 million Americans have lost their jobs. So not all of those folks, however many it was, are going to get their jobs back. So wage price pressure is probably going to stay low. I'm thinking the demand destruction is going to be there. So in the near term, I think that kind of keeps a lid on the gold price. But in a way, there I'm trying to make sense out of something, and it almost feels these days like we are in a video game and that, or, went through the looking glass or whatever in Alice in Wonderland. So near term, the gold and the U.S. dollar have been kind of moving together, which is a bit of an anomaly because historically, they're a mirror image of one another. And lately, again, the past couple of weeks, both gold and the U.S. dollar have weakened as the market has developed this risk-on attitude that's showing up across the board. I would say, the old, if I had to give you an answer and couldn't change my mind, where will gold be, 2 years from now? I'd say higher. But in the near term, I think we could struggle.
When we last talked a month ago, the crude oil market was recovering a bit from having traded at negative prices in late April. I see prices have continued to rally. Do you think this is a case of risk-on psychology in the oil market, just like the stock market, or is there something else out there driving oil higher?
Jimmy, I think it's both of those things. I think this risk-on attitude is pervasive across markets. So certainly it'll be showing up in crude. But again, let's back up. I mean, crude was call it $65 on the front months, and I'm doing this by memory, but you remember the Americans took out that the Iranian general in a missile attack, and crude spiked, and we're at $65 or thereabouts, and that was a moment when the world kind of held their breath as to whether or not the Americans and the Iranians were really going to escalate, and God knows, what that would mean for the price of oil. Likely, a lot higher. But both sides seemed to kind of back away a bit, de-escalate, whatever you want to call it, and that was the high for the year, and oil began to fall. As time went along, I guess we had the virus came along, and then we had sort of the classic boo-boo, where the Russians and the Saudis had a falling out over cutting back production, and they both walked away from the table, as it were, and the Saudis said, we're going to actually increase production prices. And then when we had the price of oil gap down, so as we went into the lows that were made here around the 20th of April when we had those negative prices, we've been on a downward trajectory for some time. So my point is, we blew it out to the downside. There was clearly, going into those lows, way more oil being produced than was being used, and we had this other existential risk of where are you going to put this oil? I mean, there is only so many places to store it, and once those things are all filled up, wow, we don't know what to think, So we were at that kind of a thinking when the market made its lows. I talked before on the show, I thought it was wrong of the Chicago Mercantile Exchange to allow prices to trade negative. It just suddenly introduced an exponentially greater amount of risk into everybody's holdings of any physical commodities. You used to think the lowest they could go was zero, but, now you're wrong about that. The markets were severely in a severe contango. In other words, the spot price for the energy products was much lower than what the future prices were. We had an interesting divergence in some of the markets. For instance, lately gasoline prices have been, let's say, rallying much more so than jet fuel. You don't have to think that through very far and to see, maybe people are going to be more likely going to take a car vacation, this summer than hop on a plane and go somewhere. That kind of follows through on that thinking. But we have seen production cutbacks. We have seen signs of demand increasing, particularly out of China. And these, what I call existential worries about where we're going to store the oil, seems to have dissipated. I don't know that we're out of the woods on that. Just like if the market, crude oil and products, are driven in part by this risk-on sentiment that's in all markets. If that risk-on sentiment turns, to risk-off, then that would hurt the whole energy sector, WTI in particular. And we've got OPEC coming up next week. That's another risk as to whether or not, they decide to continue the cutbacks that they've had. It seems as though we've got some increases in America after cutting production by about 2 million barrels in the shale patch. It's a moving target, but crude oil prices for the December delivery have got up nearly to $40 a barrel, which would be, $80 higher than where the front month traded when it was $40 negative just 6 weeks ago.
We'll have more with Victor Adair right after this.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Victor Adair. Victor, when we talked earlier this year, you said the U.S. presidential election, which is just 5 months away, was Trump's to lose. That's if the economy was in a recession, the Democrats could sweep the House, the Senate, and the presidency. Some polls showing that if the election was held today, Biden might win. Any thoughts about how politics might impact the markets?
Well, it's a huge risk, and politics are always a risk. I mean, it seems, I've been trading for a long time. And it seems as though, of course, more recent things are fresher in your memory than things that happened a couple of decades ago, but it seems that political risk is higher now than it used to be. I mean, since Trump became the president, just that all by itself seemed to change the the nature of political impact on the markets. You know, I mean, just out of nowhere, he hits the market with a zinger of a tweet. And, you know, you're looking at your price board, and all of a sudden everything kind of flashes one way and say, well, gee, what happened? Well, Trump just said something. Great. But to go back to last year, for instance, I mean, the market seemed to live and die on whether or not the Americans and the Chinese were going to come up with a trade deal. You know, the rumors out that the deal's happening and this and that, okay, the market's bid. The rumors out that things aren't going so good, you know, the market's offered. So, yeah, we had, I guess one of the major events of Trump's presidency was the tax cuts. That was certainly bullish for markets. But to get to the here and now, yeah, at the beginning of this year, I remember when I was speaking at the World Outlook Conference in Vancouver in the early part of February, when the stock market was still, you know, just virtually a week away from its all-time highs, saying that I thought that the upcoming presidential election was going to be important and that it was Trump's to lose. And my thought then was that the thing that would take out an incumbent president would be, usually is if the economy's in the tank. So I thought, gee, you know, we've been 10 years into an expansion, longest expansion since America became America. Maybe chances are that by the time we get to election day out in November, the economy will have tipped over into a recession. And then, of course, along came the virus, along came the lockdowns, and lately along came all this civil unrest in the streets, and Trump talking about putting the military in the streets. Right at the moment, the polls, and I look at a number of them, show effectively that if we had an election right now, that Biden would be elected the president. Well, I don't know that the market is pricing in what that might mean, and maybe you know the market is, and I'm just not aware of it. But it would seem that Biden would be more inclined to raise taxes than Trump, and the people that are involved in the stock market are probably allergic to higher taxes, so there would be that. Then, you know, it's not like you just wake up one morning and the election has happened. Leading up to the election, clearly, the thought would be that Trump could see what's coming, and what's he going to do about that? You know, there's folks that think he's pretty unpredictable as it is right now, and if he was looking at imminent defeat in the election, this is a guy who doesn't like to be told no. This is a guy who doesn't like to be accountable by, you know, the way I see him. God knows, you know, he might really start to get unpredictable. So yeah, there's huge risks in the election, in the lead up to the election, and certainly I'm anticipating, and so is everybody, that we're probably going to have a rather nasty election campaign over the next 5 months. It's 5 months today we have the election. And that looming election is going to become a bigger and bigger factor for the market. And, you know, if people are seeing that maybe it may be the one thing that's needed to tip the market one way or the other. And given that we've had this spectacular rally off the lows, I think we're up 40% or so on the Dow from the lows of March. You know, maybe this does turn out to be a bear market rally.
A lot of our listeners are now starting to make their own decisions about trading, and we heard from one of our frequent guests, Mike Swanson, that people who used to be betting on sports are now getting into the stock market, perhaps treating it the same way they might treat their favorite teams. You've been trading your own account for 50 years. What kind of advice could you give these newbies?
Okay. I would say this, that the profits that you make over time, not just, you know, you roll the dice and, you know, you got lucky on something, but if you want to make, you know, earn a living from doing this, the profits that you're going to make over time are going to come from how you manage your risks more than from some sort of a crystal ball, you know, got a hunch, bet a bunch view of the future that you've got. I think you need to be aware that you will have a bias And a bias is dangerous, or can be dangerous, but, you can't deny that you're going to have a bias. I certainly know I have a bias. For instance, I've mentioned a couple of times, I thought we were in a bear market rally. The fact that I had that bias, and I'm reading some pretty smart guys that have been around for a long time who sort of, confirm my opinion. So you got to watch out for that confirmation bias as well. But yeah, I thought it was a bear market rally, and I lost money in May, 2%. Can I live with that? Yeah, I can live with that. I've had a reasonably good year so far, but it does make me think, like, what was I thinking? How come I got so convinced that this was a bear market rally? Well, you read all this stuff and you form an opinion, and so I'm saying you're gonna have a bias. You gotta just be watchful about that. So the key thing then is, what are you gonna do when you're wrong? And you will be wrong. And here's my one-liner on that. There is nothing wrong with being wrong except staying wrong. If the first thing I do when I decide to put on a trade, okay, I've looked at markets, I've got this and that, and I think, okay, I'm going to pull the trigger. I'm going to buy something. I'm going to buy this thing at this price. The first thing I do before I actually, hit the buy button is I'm going to say, at what point, if that market goes against me, am I going to know I'm wrong? So that would be, my stop. Or I'll definitely have a stop in the market, sort of just in case. Something happens when I'm not around, whatever. There's some event and markets rip. I just need to know that, sort of out as a worst case, I'm going to get out at that level. Then it's also part of that risk management is sizing. You're going to go out, put a mortgage on your house and make a bet on your latest brainwave. Clearly, you read stories in the media that write stories that don't know anything about markets. They want to glorify so-and-so, Mr. Out of Nowhere that turns, $12 into a billion. Because he just took a god-awful amount of leverage and was lucky. That's not a business plan. I think you really have to just say, from my perspective, I really don't want to lose more than 2% of my trading capital on any single brainwave that I have. And I've got to tell you, I rarely would stick around to take as much as a 2% loss. But, for different folks, different strokes. Okay, going with that, think in terms of the 80-20 rule. Everybody's heard about the 80-20 rule. 20% of the sales force does 80% of the sales, and so on and so on. In terms of trading, if you trade enough over a period of time, you will find that all of the profits that you make, all of the net profits, actually came from 15 to 20% of the trades that you made. Which means that 80 to 85% of the trades that you made either lost money or, they just kind of offset the other trades that won, that you might as well have not have made them. But clearly you didn't know that or you wouldn't have. So the trade you put on, you're hoping it's going to be a profitable trade, but there's actually better than a 50% chance that it's going to be a loser. So you need to know where you're going to kick it out. So then the derivative of that, and this is really a major rule, you just absolutely have to avoid taking a big loss. I just said, my maximum loss on any one brainwave is going to be about 2%. This just suits my personality. If I was to lose 20% of my trading capital on one boneheaded trading move that I made, and I just got stubborn and I knew I was right and the market was wrong, I'd be devastated. There's two kinds of capital. There's the money in your account and there's your mental capital. You've got to keep that safe. You got to protect it. If you just shoot yourself badly in the foot, you're not going to be able to carry on. And not only just from lack of money, but you'll have no confidence. So just to wrap it up, I give you this. Do it this way. The best thing I could say for new folks that are, trading their own or getting more active in terms of, working with their broker to decide what to do, the best tool is keep a diary. Write it down. Write down, whatever you think is important. Write down, why you made the trade, what your ideas were, how come you thought this was a good thing to do, and write down also where you would get out if it doesn't go your way, and anything else that you want to write down. Keep it secret. You don't want to share it with anybody else. That way you'll be more honest in what you write down, and then go back and review it. Have a process whereby, you hold yourself accountable to doing what you said you would do, that kind of thing. So, I write a blog every week where I talk about what I'm seeing in the market, some of the trades that I'm doing, and I post it on the website, and warts and all. I'll write down when I make a money-losing mistake in the market or whatever. But anyway, I think that's a great tool, and just understand it's a marathon, not a sprint. I feel like I'm reading off a list of cliches, but that's real. You're going to grind along, and you're going to have periods of time when you really can't find your ass with both hands, and you're going to have other times when you think you're God's gift, and, you just never know when those things are going to come and go.
Victor, thank you so much for being on the show.
Jimmy, thank you. As always, it was a lot of fun.
My guest has been Victor Adair, co-founder of the Polar Futures Group, his website polarfuturesgroup.com. If you have any questions for Victor or any of our other guests, you can send them to info@housestreet.com. Find us on Twitter @HouseStreet. Our YouTube channel is Talk Digital Network. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of House Street Media Incorporated.